$73 billion. That is what Samsung just announced it will spend on semiconductors in 2026 alone, the single largest annual semiconductor investment by any company in the history of the industry. More than TSMC's projected $45 billion, more than Intel, more than anyone ever in a single year. And yet, Samsung's foundry market share has plummeted to just 7.2%, while TSMC commands nearly 70%. Something doesn't add up. Or does it?
Welcome back to Asia Tech Macro. I'm Maya, and today we're unpacking what might be the most consequential corporate bet in Asian technology right now. On March 19th, Samsung Electronics announced it would invest 110 trillion won, roughly $73 billion, in capital expenditures and research for 2026. But this isn't just a Samsung story. It's the story of a global memory crisis that's about to make your next smartphone and laptop significantly more expensive. And it's all because AI is eating the world's memory chip supply.
208% profit growth. That's massive. So Samsung is clearly doing well. Why the $73 billion investment urgency? Because Samsung is simultaneously winning and losing. On the memory side, they're printing money. DRAM prices have surged, with Samsung raising prices on 32GB DDR5 modules from $149 to $239, a 60% increase. Throughout 2025, DRAM prices rose a staggering 172%. Samsung is the world's largest memory producer, so rising prices flow directly to the bottom line.
But on the foundry side?
Disaster. Samsung's foundry market share has collapsed to 7.2%, while TSMC holds 69.9%. Their most important foundry customer, Tesla, experienced a 6-month delay on their AI6 chip. Samsung's Texas fab has had production issues. The gap between Samsung and TSMC in advanced logic manufacturing is wider than it's ever been.
So the $73 billion is an attempt to fix the foundry while riding the memory wave?
That's exactly right. The 110 trillion won covers capital expenditures across semiconductor fabrication facilities, memory production lines, advanced packaging infrastructure, and R&D on next-generation process nodes. But here's the twist that makes this story fascinating. Samsung just achieved something critical in the HBM space. They became the first company to commercially ship HBM4 chips, beating SK Hynix to market. And at NVIDIA's GTC 2026, Jensen Huang personally endorsed Samsung's next-generation HBM4E chip on stage.
Wait, Jensen Huang endorsed Samsung? That's a huge deal given that NVIDIA had been mostly working with SK Hynix for HBM.
It's a potential inflection point. Samsung's HBM3E had failed NVIDIA's qualification 3 times, which was a humiliating public narrative. The HBM4 breakthrough and the Jensen endorsement suggest Samsung has resolved its technical issues. If Samsung can secure a significant share of NVIDIA's HBM4 orders for the Vera Rubin platform, the revenue implications are enormous.
So the $73 billion bet is really about 2 things: doubling down on memory where they're strong, and trying to close the gap in foundry where they're weak.
And both are driven by the same underlying force, AI demand. The AI infrastructure build-out is creating insatiable demand for both memory and logic chips, and Samsung is positioning itself to capture value on both sides. The question is whether $73 billion is enough to fix a foundry business that's been losing ground for 5 years.
Let's talk about the geopolitics, because this is where the undersea cable story gets really spicy. Who builds the cables, where they land, and who controls them has become a major front in the US-China tech competition.
The submarine cable construction market is dominated by 3 companies: Subcom, which is American, Alcatel Submarine Networks, or ASN, which is French and owned by Nokia, and NEC, which is Japanese. Together, they control over 60% of wet plant revenue, which is the actual undersea equipment. But there's a 4th player that has been growing aggressively, HMN Technologies, formerly known as Huawei Marine Networks, which is Chinese.
Wait, this was literally Huawei's submarine cable division?
Yes, it was spun off and rebranded, but the lineage is direct. HMN Technologies has become the fastest-growing subsea cable builder over the past decade. They've laid 18% of the world's new submarine cables in the last 4 years. They were involved in 16 projects worth $1.6 billion across 27 countries. And their competitive advantage is price. HMN bids 20 to 30% lower than Western firms.
20 to 30% cheaper. For countries with limited budgets, that's a huge difference.
It's the same playbook Huawei used in telecom infrastructure: offer dramatically lower prices, win market share in developing countries, and build a network of dependencies. and the U.S. has responded the same way. Washington has effectively blocked Chinese companies from participating in subsea cable projects that involve American investment or touch American shores.
So we're seeing the same bifurcation underwater that we're seeing in semiconductors, AI chips, and social media.
Exactly. CSIS published a major study on this, warning that subsea cable systems are increasingly aligning along Western or Chinese technology ecosystems. The cables built by Google and Meta route through allied countries, Singapore, Japan, the Philippines, Australia, Guam. They deliberately avoid Chinese territorial waters and Chinese landing stations. Meanwhile, HMN Technologies is building cables for Belt and Road countries in Southeast Asia, Africa, and South America. The physical internet is splitting into two networks, and the fault line runs through Asia.
And Singapore is at the center of this, right?
Singapore is the most important submarine cable hub in Asia, arguably in the world. It has the densest concentration of international cables in the region, and it's where virtually every major new cable project plans a landing station. CSIS did a detailed case study on Singapore's strategic position, noting that the city-state has emerged as the region's leading digital hub precisely because of its cable density. Singapore has several new cable projects lined up for 2026, 2027, and 2028, connecting to other Southeast Asian countries, the U.S. via Guam, the Middle East, and Australia.
But doesn't that concentration also create a vulnerability? If something happens to Singapore's cable infrastructure, the whole region has a problem.
That's exactly the concern. And it's one reason we're seeing deliberate diversification of cable routes. Google's Thailand link goes to Thailand via the Indian Ocean specifically to avoid the Sunda Strait bottleneck, where many existing cables converge. Other new cables are routing through the Java Sea to avoid the South China Sea, where Beijing's territorial claims have already affected cable projects. The Apricot and Echo cables, both important trans-Pacific routes, were rerouted around Indonesia instead of through the South China Sea due to geopolitical concerns.
Cables rerouted to avoid the South China Sea? That's a tangible example of how military tensions affect digital infrastructure.
And it gets more concerning. CSIS published another report noting that China has developed a specialized cable-cutting ship, which they diplomatically describe as a dual-use vessel for both cable repair and potentially cable disruption. Geopolitical tensions during gray zone periods between peace and conflict could increase the risk of deliberate interference with submarine cables. This isn't science fiction. The Baltic Sea experienced suspected cable sabotage in 2023 and 2024, with investigations pointing to both Russian and Chinese-flagged vessels.
So we're literally talking about the physical cables that carry the internet being potential military targets?
In a Taiwan contingency scenario, cutting the submarine cables connecting Taiwan to the rest of the world would be one of the first actions in any blockade or military operation. Taiwan's digital connectivity to the global internet runs almost entirely through submarine cables. This is why the diversification of cable routes and the building of redundant paths, which is exactly what Google and Meta are doing, is as much a national security investment as a commercial one.
Contrarian Corner. The consensus view is that Samsung's $73 billion bet is a desperate catch-up play. TSMC dominates foundry, SK Hynix dominates HBM, and Samsung is playing defense on both fronts with a massive check. Alex, what's the angle nobody's considering?
The contrarian thesis is this. Samsung might be the only company in the world that can solve the memory crisis, because it's the only company that operates at scale in both memory and logic manufacturing. And that dual capability could become its greatest competitive advantage, not its weakness.
How so?
Think about the direction the semiconductor industry is heading. The future of AI chips isn't just about the GPU or the CPU. It's about the integration of compute and memory. NVIDIA's Vera Rubin platform, AMD's MI400, Google's TPU v7, they all require ever closer integration between the logic chip and the HBM stacks. This is why advanced packaging technologies like TSMC's CoWoS and Samsung's iCube are so critical. They physically bond the memory and logic chips together.
And Samsung makes both the memory and the logic.
Exactly. TSMC makes the logic but has to buy HBM from SK Hynix or Samsung. SK Hynix makes the HBM but has to rely on TSMC for the logic. Samsung is the only company that can, in theory, manufacture both the logic chip and the HBM stack and do the advanced packaging all under one roof. That's a vertically integrated AI chip supply chain that nobody else can replicate.
Okay, but if Samsung's foundry is at 7.2% market share, the logic side of that integration isn't exactly world-class right now.
Fair point. And that's why the $73 billion matters. If even a portion of that investment goes toward improving Samsung's advanced node foundry capabilities, say getting their 2-nanometer GAA process to competitive yields, the integration story becomes real.
The NVIDIA endorsement of Samsung's HBM4E at GTC suggests NVIDIA is at least open to a deeper relationship, and NVIDIA has a strategic interest in having a second source beyond TSMC for logic manufacturing and a second source beyond SK Hynix for HBM.
NVIDIA doesn't want to be dependent on any single supplier.
Nobody does. And this is where Samsung's negotiating position is stronger than its market share suggests. NVIDIA needs supply chain diversity. Samsung can offer it across both memory and logic. That's a compelling value proposition even if Samsung's foundry yields aren't quite at TSMC's level.
There's another contrarian angle I want to explore. The memory shortage itself might have a silver lining for consumers in the long run. How?
If sustained high memory prices make smartphones and PCs more expensive, that creates powerful incentives for innovation in two areas. First, more efficient memory architectures. Companies are already working on processing in-memory, or PIM technology, that reduces the amount of memory needed for AI workloads by performing computation directly in the memory chip rather than shuttling data back and forth. Samsung actually demonstrated PIM technology in their latest HBM4 design.
So the shortage might accelerate the development of more efficient memory technologies.
And second, it accelerates the shift towards software optimization. If hardware memory becomes expensive, software developers have stronger incentives to optimize their code for memory efficiency. We've already seen this in the AI space. DeepSeek's success with efficient training at lower cost is partly a response to hardware constraints. The same dynamic could play out across the software industry. Expensive memory forces better software engineering.
That's actually a good point. The history of computing is full of examples where hardware constraints drove software innovation. The original iPhone had 128 megabytes of RAM and ran a remarkably capable operating system.
Exactly. Constraints breed creativity. The question is whether the memory shortage of 2026 is painful enough to drive meaningful innovation or merely inconvenient enough to raise prices without changing behavior. Given that IDC is projecting a potential 9% decline in PC shipments, I'd argue we're crossing into the painful territory that forces real adaptation.
Action items. How should investors and business professionals navigate Samsung's $73 billion bet and the memory shortage?
3 specific actions. First, track Samsung's HBM4 qualification progress with NVIDIA as the single most important near-term signal for whether Samsung's turnaround thesis is real. The Jensen Huang endorsement at GTC was symbolically important, but what matters is commercial orders. Watch for any announcements of Samsung HBM4 or HBM4E being qualified for NVIDIA's Vera Rubin platform alongside SK Hynix. If Samsung secures even 30% of Vera Rubin's HBM allocation, it validates the vertical integration thesis and signals that the $73 billion investment is generating returns in the highest margin segment. The metric to track is Samsung's HBM revenue share, which you can estimate from their quarterly earnings reports by looking at the memory division's product mix commentary. Second, if you're in consumer electronics, hardware manufacturing, or enterprise IT procurement, start budgeting for 15 to 25% higher memory costs through at least mid-2028. The shortage is structural, not cyclical. New fab capacity from Samsung's investment won't come online until 2028 at the earliest. IDC's projection of a potential 9% decline in PC shipments and 6 to 8% ASP increases in PCs should be your planning baseline. For smartphone manufacturers, the Xiaomi example of a 25% DRAM cost increase per unit is the benchmark. Companies that lock in memory supply contracts now, even at elevated prices, will have a competitive advantage over those who wait and face spot market premiums later.
And third?
Third, watch for regulatory intervention in the memory market. The last time DRAM prices surged this dramatically in 2017 to 2018, Chinese regulators launched antitrust investigations into Samsung, SK Hynix, and Micron, alleging price collusion. China's State Administration for Market Regulation, or SAMR, has shown it's willing to investigate memory makers. If memory prices continue rising through 2026, particularly affecting Chinese smartphone manufacturers like Xiaomi, Oppo, and Vivo, a repeat investigation is plausible. Any antitrust action would create significant uncertainty for memory stocks and could force manufacturers to accelerate capacity expansion. Track SAMR statements and any Chinese media coverage alleging anti-competitive behavior in the memory market.
The big picture takeaway is that Samsung's $73 billion bet crystallizes one of the most important dynamics in the global technology industry right now. AI demand is so overwhelming that it's reshaping the entire semiconductor supply chain, not just the companies making AI chips, but the memory makers, the packaging companies, and ultimately the consumers who buy phones and laptops.
And Samsung is unique in being the company most exposed to both sides of this dynamic. Their memory division is the biggest beneficiary of AI-driven demand. Their foundry division is the biggest casualty of TSMC's dominance. And the $73 billion investment is an attempt to win on both fronts simultaneously. If they succeed, Samsung becomes the most important semiconductor company in the world, full stop. If they fail, the $73 billion becomes the most expensive insurance policy in corporate history.
That framing of it as an insurance policy is really sharp, because even if the foundry doesn't catch TSMC, the memory profits alone might justify the spending.
And that's the bet. Samsung is essentially using memory profits to fund a foundry moonshot. If the moonshot works, they're the undisputed champion. If it doesn't, they're still the world's largest memory company printing record profits. It's an asymmetric bet with a very high floor.
And if you want the full breakdown of Samsung's investment allocation, the memory pricing data, and the IDC consumer impact projections, we publish a free daily newsletter at asiatechmacro.substack.com.
Coming up next, we're going to examine how Asian central banks are navigating the dollar strength dilemma. The BOJ, RBI, Bank of Korea, and Bank Indonesia are making very different bets on rates and currencies. The policy divergence is creating fascinating cross-asset opportunities.
Can't wait. Thanks, everyone.
Stay data-driven. Bye.